Hi, folks. Thanks for joining us again today for the next session of CPS Live. We have a stellar, very full lineup for you today, so hope you're excited. If you have any questions during the presentation, you can enter them into the chat or Q&A panel, or if you'd like, use the raise your hand tool, and I'll modify your controls so you can unmute your line and ask it live. Without further ado, here's our MC, Mr. Tom Berkler.
Lisa, thank you. Thank you. Lisa, the voice of Pennsylvania speaking to you there to kick off the show. September 6th. Yeah. I guess fall really doesn't start till September 21, but I always kind of feel like Labor Day is the beginning of fall. You'd never know it looking at Tom and Scott. Both don't you both know you're not supposed to wear white after Labor Day? Matt Gandy and I, being dedicated followers of fashion, not only are not wearing white, we matched up today. No I in team, despite your fashion faux pas, Tom Nichols. I'm going to kick off with you just before we get started. An unfamiliar face on here, Dan Grissett. Grissett is new on the CPS team, and he's going to be introduced a little later on, but everybody else is familiar. The man that needs no introduction is next, Tom Nichols. Go ahead, Tom. I understand you're going to talk to us about not only are you going to give us disability cover, you're going to give us our money back before it's done. Is that right? Am I oversimplifying?
This is correct. One of those overlooked little features that we've got built into our income protection plan is the ability to get all of our money back if we never use it. And so if you have those clients that might be reluctant to purchase an income protection plan, you can share with them the insights of a return of premium option. And I had a recent success that I wanted to share with you because I had an advisor come to me and say, Tom, who are the people that are buying this return of premium option with their disability insurance? And I told them it's going to be your money managers, it's going to be your financial advisors, CPAs. And they go, why is that? Because they get it. They understand that return of premium value and the time use of the money. And I'm going to show you a quick example here of why the CPAs, the financial advisors, and wealth managers are buying and selling this return of premium option. So let me just share this here real quick. So this is a real estate advisor who's 35 years old, and he is buying his disability insurance. He makes $250,000 a year. He gets a $12,000 tax-free monthly benefit if he gets sick or hurt and can't be a real estate agent. And that benefit can be payable all the way to age 65 if he doesn't get any better after a 90-day wait. Now, the premium for this policy is going to be $2,500. Now, remember, he makes $250,000 a year. So this is roughly 1% of his earnings each year. And of course, as a wealth manager, we want to show him the return of premium option. It's going to cost a little more. The money can be taken right out of the brokerage account in order to offset this benefit. But the premium now goes to $5,000. Now we've got 2% of his earnings to protect his income if he gets sick or hurt. But if we go to the dollars and cents section right here, the additional cost is $2,400 a year, a little over $2,460. And so Mutual of Omaha has a return of premium option that will pay you back every 10 years. You don't even have to wait until you're 65. So he's 35. When he's 45, when he's 55, he's going to get a tax-free check from Mutual of Omaha for $40,188. His cost for this $40,000 is $24,604. So here's the real question. What would I have to earn on my $2,400.60 a year in order to get a check for $40,000 tax-free every 10 years? And the answer is right here, 8.76% guaranteed every year for 10 years for the life of the contract. They'll pay that $40,000. So that's why wealth managers, financial advisors, CPAs are the ones that are selling and writing these products for their clients. The case that I'm showing you right now is a real case. And the advisor told me, says, can we set it up so that the premium payment comes to my office so I can just pay the premium right out of the client's brokerage account? And I said, that's not a problem. They'll be happy to send you the bill every year. And then when the money comes back, he can just dump it right back into the brokerage account. Okay, so that's the quick and short of it. Protect your client's income if they get sick or hurt. Now, myself and my trusted associate, Steve Jones, are available even for point of sale to help you with these, to talk about the numbers, the benefits, the features. Get us involved. We're happy to support you. Give us a call and we'll put these plans together. And you may always want to show both. Whenever you're requesting a proposal request, always go, hey, show me that return of premium option. So that's it for me. I will hand it back over to you, Mr.
Tom,
Tom Berkler.
just to clarify, the money you get back on the 10 years is, if you haven't received a benefit, is that the full premium or the additional premium that you paid to get the guarantee?
That is actually 80% of your total premium paid is returned to you every 10 years.
And what effect does the return you get in 10 years have if you've collected benefits during that period?
Well, they will pay you 80% of all the premiums paid minus any benefit that may have been paid out.
But every 10 years is a fresh start. Then you start all over again.
That is correct.
Yeah. Really what you're talking about with the additional premium here is you're going to be guaranteed to get at least 80% of your money now, whether it's a cash refund or in the form of benefits.
Yeah, he could have just bought a disability insurance policy, paid the $2,500 a year. Every 10 years, he's out $25,000.
Yeah. Tom, you and I have kicked this around before. This eliminates a lot of the use it or lose it stigma that used to hang over income replacement in the past. Thank you. Thank you. And I think Lisa's put your contact info up there. Scotty White, you're not ignoring fashion. You just wanted a shirt that matched your last name, Scotty. I was a little hard on you earlier there, and I apologize.
That's okay, Tom.
To demonstrate my remorse, I'm going to give you 5 minutes to talk to us today about taxable versus non-taxable
Appreciate
yields,
it.
Scotty.
Absolutely. So, for those of you on the call, if you're in the fixed annuity marketplace, you know how much sales have grown this year since last September, October last year, when we started to see some of these interest rate hikes. And if you're not in the annuity gamut, or you haven't been, that's okay, because for the last 12 years, a lot of this stuff didn't make a lot of sense to some people because the rates were so low. So I'm talking to a lot of advisors, both, RIAs, money managers, people that don't focus on this stuff, even some PNC reps that are looking to get into the annuity marketplace because there's such a boom in interest rates right now. And I think we're at, and Matt, you could probably correct me if you have a difference of opinion, but near the top of the interest rate boom, I think. That said, the easiest way to get into the annuity marketplace is with these products you see in front of your screen. This is our multi-year guarantee rate sheet. And if these numbers don't sell themselves, I have another tool that I want to share with you guys that'll help in that endeavor. But the rates that we're seeing right now, the top rate in the industry is 6% guaranteed for 10 years. Now, normally, under normal circumstances, I would think a 3 or a 4 or a 5 year. We're more accustomed to selling those in the last 12 years because of the low interest rate environment, but might not be a bad idea if you're looking at a client that has a longer time horizon to lock up that money longer and take advantage of these high rates while we have them now. So 6% for 10 years. And to Tom's point, I do want to talk about taxable versus non-taxable yield. Obviously, all these annuity products, even on the non-qualified side, they are all non-taxable, tax-deferred vehicles. And I like to kind of coin the phrase triple compounding. And really what I mean by that is you earn interest on your money, you earn interest on your interest, and then you earn interest on the money you would have paid in taxes. And I think to illustrate that point, this is a little Excel grid that I just made for this call. Here's our $100,000 deposit going in, 6% for all 10 years. The interest remains intact and stays in the policy, and that grows to 179 and change. On the right-hand side, what I have is the taxable yield that you would need in order to equate to that same future value of around $179,000. And this is assuming about a 35% tax bracket. So a couple disclosures here, right? Number one, if you're paying the tax every single year on the right-hand side in a taxable asset, this is now tax-free at the end of the period, because you've been paying it in perpetuity. On the right-hand side, or on the left-hand side, excuse me, you got the 179. That 79,000 is going to stay in the policy until you withdraw it. We all know it's, or we should know that its interest is withdrawn first. So it's LIFO is the term, last in, first out. And you might be saying, okay, well, that's nice. You know, a 9.23% taxable yield is what's needed to equate to our 6% tax-free yield, but I have all this taxable gain built up in the policy. So what we can look at here is this is the same grid from above, our taxable yield, but I reduced it to 6% to kind of show you an apples to apples comparison, this taxable yield versus our non-taxable yield on the left. So on the left, we have the 179 that we would have built up in our tax deferred vehicle. All the gain is taxable. If you were to take this out as a lump sum withdrawal, which you would never do, or you should never do, because those taxes are gonna kill you. Even if a lump sum withdrawal is taken, you're still coming out ahead when you're looking at taxable versus non-taxable yield. Typically, what you would do as is some income planning and distribute this over a number of years to spread out that tax liability, or maybe even use something like a SPIA or another annuitization tool to take advantage of exclusion ratios to really mitigate this tax hit. So this is available in an email campaign as well. We've done a few where we've sent these out to advisors and to clients, and the title is, hey, 9.23% yield. Is that, you know, is that a favorable yield in your equities marketplace or your taxable yield marketplace? And then you can kind of back into that conversation with some of these MIGAs. So give me a call if you're looking to get into this marketplace. I think there's never been a better time. The rates are here. These products have never been better. So we're eager to work with you.
Scotty, let me ask a question. I know that people are looking at these rates now that have bought annuities over the past few years and think, oh, golly, I'm in a much lower interest rate product. And I'm still under some surrender charges. Have you bumped into clients where there's been such a dramatic leap in the interest rate that it's still beneficial for them to move from one annuity, even though there's some remaining surrender charge, and do the 1035 to a new product? And if that's the case, is there kind of a rule of thumb as to where maybe that works?
Yes. So older policies, if they were, general rule of thumb is they need to be about 3 years old. If they're 2 years old, it's not a no, but generally about 3 years old or older, you can look at some replacement opportunities. And surrender charges 7% or less. And what we typically find is, you know, let's take a 5% surrender charge, for example. Some of these policies that were written, you know, 3-4 years ago, we'll look at an index case, for example. Some of these caps were around 5%. And I have bonus products that will cover that loss, that 5% loss on the surrender charge, and the caps are in the tens. So you're doubling the upside potential for a client, and it's just a lateral move from their account value perspective. You're making it up with the bonus. So it's another huge opportunity.
And Scotty, I've talked in the past too, not to ever forget, if you are locked into an annuity where you'd suffer too much from the surrender charges, we're always ready to help people with those 10% free withdrawals every year. because with annuity, you can do a partial 1035 exchange into one of these higher generating products.
Tom, you didn't even need me on this call. All those points are perfect.
That's a rare occasion. People that have tuned in today are witnessing new stuff. Scotty, thank you. And I know Lisa's got your information up there. Matt Anderson, Matt, we know you can do great presentations. Today, you're going to show us how good you are at introductions, because we do have Dan Grissett with us, who is our new Medicare specialist. And you're going to introduce him. Dan, let us know what you can do to help the folks out there. Welcome aboard to the CPS team, and welcome to CPS Live. I think your appearance here today is going to be good for your resume. All right, Matt,
Perfect.
take it away.
Perfect. Thank you, Tom. For those of you that don't already know, not only can CPS help you out with your life insurance, annuities, DI, LTC, 401k planning, but we can also help you and your clients out with Medicare planning. And that help from CPS really comes in one of two different ways. If you're currently already in the Medicare space, we can help certainly support you and help grow that part of your business. But today we wanted to spend some time talking about the second way that we can support you is if you're not currently in that space, if you're not currently helping your clients that are turning 65 and that need Medicare advice or guidance, we can help you out with that. And Dan Grissett really can assist with that. So Dan, I'm gonna let you take it from here. Tell us how you can help support, our advisors that are not currently helping their clients with Medicare.
Thank you, Matt. It's great that we can kind of give you a quick summary of ways to help you if you're not working presently in the Medicare space. I'm available to team up with you to deliver answers and solutions to your clients who are turning 65. These kind of advisory services are not only good for client retention, they can get you a referral fee when coverages are chosen by your client. A key point, Medicare is not your usual insurance situation. One, it's mandatory when a person turns 65. And secondly, and this has always been fascinating, coverage is guaranteed when starting at the right time. Advising is critical.
Dan, you love to say that with a smile, and I'm so jealous. I wish that I had something that was guarantee issue, but congrats to you.
There's some benefits in looking for faster pathways, and I'm old enough to perhaps learned a lesson or two about life insurance underwriting or certainly long-term care. This is something that allows us to be very helpful to agents and advisors. It's critical in terms of this advising that answers be available to clients, because the timing of enrollment in parts A and B of Medicare, getting that done correctly will eliminate lifetime late enrollment penalties. It goes without saying that turning 65 is, for practically anybody that will meet, is a madhouse of confusion. There's direct daily mail. Call centers are busy making phone calls, and on TV you can watch Joe Namath and various other players kind of hype all kinds of features of Medicare that typically combine products in the presentation, products that are irreconcilable with each other, but it sure makes good viewing when you're TV watching at that time. So it's an environment of a great deal of confusion, and especially true starting now until the rest of the year, when Medicare has its annual enrollment period that starts October 15th and continues through December 7th. And so there's just a lot of things going on that are inevitably creating confusion for your client who is turning 65 at this point, or is already in some kind of Medicare product and needs, for example, to have a drug plan coverage reviewed, because every year Medicare changes drug plans. And so if you've had a drug plan this year or 2 or 3 years ago, and you haven't had that plan reviewed, it needs to be reviewed. I've had clients that kind of went asleep at the switch and ended up having drug plans that were way, way too expensive than what they actually needed. And so this kind of service is really effective in building client goodwill and trust, and is all oriented to being able to answer questions, because it's in answering questions that everyone has about Medicare, without exception. We have an opportunity to be of service, and in being of service, we expect opportunities are going to follow there soon thereafter. So my CPS phone number is 949-255-1744. And I'm available to take your call and give you assistance. The key is having you, if you're not in the space, arrange a brief email introduction and connect me with a client who's turning 65. For some of you, you may already be getting emails because in the CPS database, a client is showing up as about to turn 65, and this is a heads up which allows you to get in front of the noise and start a conversation that will be helpful to your clients.
Dan, we didn't talk, so I hope I'm not throwing you a curveball here. But if I am, and you can't answer yes, say yes anyway, because nobody remembers anything here. So, I know, having been through the Medicare plan, we've got Medicare A and we've got Medicare B, and then we've got the supplements that you can get, and the drug plan that you mentioned. It's 4-part, and then you examine Medicare Advantage. If anybody has any questions on any aspect of these parts, you're there to help them walk through those parts. Am I correct? You're comprehensive in your advice on this.
That is correct. It never hurts to answer questions, and it's remarkable over time how that opens up an opportunity to be helpful. And I would say, even looking at the whole panel here, that having that conversation between an advisor or the agent and his client about this may activate other opportunities, perhaps for annuities. Yeah. And even, Matt Anderson getting right into the excitement of long-term care.
Yeah. And the enrollment period is the gotcha for everybody. They don't realize that we've got some time constraints there. My advice would be to anybody, ignore the mail and just give you a call, and you'll get them on the right track. Now, if Scotty gets mail from Joe Namath, he's going to open that, because as we've talked about Alabama earlier, that's just something he can't put aside. Dan, welcome aboard. Matt, thank you for getting Dan onto the platform here. Last but not least, Matt Gandy. Matt and I have a joke whenever we get an offer back from a carrier where it's rated, that the way you sell a rated policy to a client is you say, look, I understand that the premiums are higher. That's the bad news. The good news, you aren't going to have to pay them for as long. Matt, haven't you found that to work?
Mathematically, I think there's some truth there. And what I wanted to briefly go over today was just a quick case study on something that we saw a couple weeks ago. Actually just finished up placing these cases, and what we had was one of our advisors out in Texas brought us a nice insurance opportunity for a client that is 50 years old and was looking for $4 million of various term insurance. Now, tell me if you've heard this story before. Things didn't go quite as planned. Advisors quoting preferred. I will say we always recommend starting at standard, because things can go up, things can go down. Ultimately, this client was approved at table 4. That typically is approached with a air sucking from the room as we realize this is about to get a lot more difficult. Well, that's where CPS really shines and can show its value. First thing we did immediately after receiving that approval at table 4, shopped it out to our underwriting team, who took it to market and said, hey, is this a fair offer? Is this going to be competitive? with regards to the whole insurance market. Turns out this was actually a pretty aggressive offer. We're seeing declines, we're seeing table fives. And so the next step is, what are we going to do? And this is a little bit of how the sausage is made on our team. I'm going to take control of the screen here. And so the first step was we looked at the term insurance and came up with the advisors say, hey, look, you need 4 million. How long do you need 4 million for? As we get older, typically our insurance needs do decline in most situations. So what we come up with is we're going to look at 10 years, we're going to need $1 million. After 10 years, we're likely not going to need that, as we're going to have, a declining debt and a declining income replacement need as we're getting older. We're going to carry 2 million for 15 years. And then for 20 years, we're going to keep $1 million. You might know this as a term life insurance ladder. Well, this is good. And this marginally got us closer to the initial quoted premium, but it didn't stop there. Behind the scenes, as soon as we see this, and advisors on the call, remember this: over age 50, table rated, you're going to want to make sure that someone does this for you. CPS is automatically going to do it, as you know from working with us. And if you're new to us, as Dan was kind of alluding to, CPS's alpha, our bread and butter, is we're a high service organization. We have a lot of really talented staff who can alert you to certain things. In this case, it's a pricing anomaly. So we went and looked at this particular term product. We took this monthly premium and we said, hey, what happens if we plug it into our the same carriers with the same offer into their permanent product? So we plug in that same 10-year term for $1 million, same underwriting offer, same everything, same monthly premium. We have made no changes from the client's perspective, but we've just changed the product from a term product to a UL. We're only going to talk about the guarantees here. Same premium, same company, same client, same offer. This policy, when we moved it from term to permanent, now lasts for 13 years and 2 months roughly versus 10. Plus, this is now a flexible premium adjustable life insurance policy, right? The formal name for universal life. If the client gets to year 4, decides my needs have changed again, I need to keep this $1 million for longer, no problem. Don't need to even contact the carrier. We'll put some more money in, run the calculations, and determine what we need to pay to get this to last till 15 years, 20 years, till they're age 90, till they're age 100. We have all that flexibility. Not to mention, this client's already at table 4. They've already indicated they're probably not going to need this more than 10 years. Well, at age 60 here, this client may be eligible for a life settlement. We could look at selling this policy when typically a term policy isn't going to afford you that opportunity to look at the secondary market because the conversion is not, going to be sufficient to get accurate pricing. This is a highly competitive product, as you can see here. We did that for the 15-year, $2 million. This policy now lasts for 17 years and some change. Again, nothing different, just moved it to the permanent plan, and same with the 20-year option. Same monthly premium, put it on the permanent plan, got the client additional flexibility. They now have a permanent asset rather than just a liability in a term policy that they can even sell later as a possibility. Not to mention our advisor compensation changed with this arrangement as well. Rather than getting for the term policies $19,949, certainly a nice case, something that we would all take a look at. I think we could agree, to over a $65,000 total commissions, including the 2-year rolling target. It's a pretty big difference. We call this a win-win. Win for the advisor. They're getting significantly more compensation. win for the client because they're getting a more flexible product, a cheaper product with more value. So this is something CPS is automatically doing for you, but just always want to make people aware. If you see it over age 50, table rate, this might be an opportunity for you.
I don't know about everybody else on the call, but 45,000 additional commission, that would change my weekend, Matt. One of the things you commented on, you were with this very creative solution, you still had to dig a little bit out of the hole from the fact that the agent overrepresented what the expectations were in the beginning. And I know you and I, the whole life team, struggle, especially when we're getting clients about whom we know very little over 60. We always cautiously put out preliminary ledgers showing standard. But that's such a problem because there's always some unscrupulous agent coming out of the wainscot that is there to show them preferred and say, oh, I see, I could do this better, and they get themselves positioned. But this is good. Thank you, Matt. Very, very good. So anybody got any last words they want to throw in here for the folks? Thank you very much. Dan, thank you. Good first performance. I think we're going to call you back one of these days. Some of the others are questionable, but you're good, Dan. All right. Folks, you all have a good day. Lisa, so why don't you take us out of here if we don't have any questions in the box?
We are clear on questions. So thanks again for joining us, folks. Hope to see you next time.
Thank you. Bye-bye.